Hi everyone, and welcome back to FOW Asia. I'm Joy Teo of Global Investor Group. Thank you earlier, Yiping and Natasha, for sharing the example of accessing to Chinese futures market. We are now moving on to the next panel, trading and investing while keeping risk in check, to discuss strategies as we move past the pandemic. Moderating the panel, I'm delighted to welcome Mr. Jing Li, the General Manager of Asset Management Department of ICBC-AXA Life. Jing specializes in investment management, structured product development, derivative and dynamic asset allocation strategies in US and China. To discuss this topic, Jing is joined by our panelists from Absolute Return Investment Management Association of China, True Partner Capital, and Optiver China. Remember, we're not only to hear from our speakers, but we would like to hear from you. So please do ask questions throughout the session via the Q&A functions on your screen. Every session is being recorded and will be available on demand. So now I'd like to hand over to Jing to get the panel started. Jing, over to you.
Okay, thank you, Joy. I'm very honored to have the opportunity to discuss about this topic with three great panelists. How about this? Let's spend 12 minutes to let each of the panelists to introduce themselves about their strengths and their expertise. So how about let Govert to start your self-introduction?
Hi, yes, thanks, Jin. So my name is Govert Heijboer. I'm the Co-Chief Investment Officer of True Partner Capital. So True Partner Capital is an alternative asset manager. We're listed in Hong Kong, and we primarily focus on volatility trading, so derivatives, options, and futures, and primarily in equity indices and equity, also with a focus on Asia. And as an alternative asset manager, we currently manage roughly about $1.6 billion US.
Well, how about you introduce yourself?
Yeah, thanks, Jing. My name is Will, and I am the Chief Strategy Officer in Optiver China, based on Shanghai. And as a part of Optiver Asia Pacific, our Shanghai office has been in operation for 8 years. Our local presence is growing fast, and we are active participant in Chinese financial markets. And we are actually trading across multiple asset classes. So it is my pleasure to attend this panel and share my views in trading and risk management by trading futures and options, especially in Chinese market. Yeah, thank you.
Thank you, Will. And Jeff, it's your turn.
All right, thank you. My name is Jeff Nie. I'm the co-chairman of Absolute Return Investment Management Association of China. It's an association was set up in Hong Kong over 10 years ago. And the mission for the association is to promote the hedge funds philosophy, strategies, process, and ethical codes to mainland China. So each year we host a number of big events, including the annual conference. And actually, over thousands and tens of thousands people attended our conference. Myself used to work at Goldman Sachs Fund of Hedge Funds and Merrill Lynch Fund of Hedge Funds and other fund of hedge fund firms. So I will share my views from a market participant and also asset allocator point of view with you. Thank you.
Okay. Thank you all of you. And to begin our discussion, how about let's have a quick round of quick discussion of our view on the current market and what's your the near-term and the mid-term view on the market. So let me hand it over to Govert. Can you share with us your market view?
Sorry, one sec. Yeah, so I would like to talk a little bit about the current global macroeconomic outlook. I guess, unfortunately, when you talk about the macroeconomic outlook at the moment, you cannot do this without at least mentioning the word COVID about 1,000 times. I think the world is currently at a crossroads, not only for the whole COVID situation, which obviously limits the personal mobility and also gives rise to various supply chain issues and maybe new variants. But I think the main crossroad point is also that there's currently starting to be like two very distinct camps when it comes to policy with regards to COVID and in general. So first of all, you have the so-called zero COVID camp versus the living with COVID camp. Yeah, like I'm based in Hong Kong, so Hong Kong, mainland China, but also Australia are more in the zero COVID camp, trying to get rid of it completely, whereas other countries like Europe, US, even Singapore, it's more about that you have to, this is going to stay and you have to live with it, which of course has big implications on how to conduct business, how it's happening now with borders, traveling, tourism, etc. Separately, and it's a sort of a distinction along the same lines, there's also a different approach when it comes to, let's say, the role of the central banks, and let's say active central bank role interference in the markets, where it's obvious that in the Europe, US, Japan, with the exceptional measures like quantitative easing, etc., this role is very significant, whereas in other Asian countries, like especially mainland China, but also like South Korea, where they recently raised interest rates again, the central bank role is much more muted. So again, this also impacts various things, rates, assets, etc. I think one thing and that's the third thing, you also see increased regulation much more sharply recently, of course, in mainland China with respect to online companies, social media, etc. Whereas in Europe and US, they have been talking about additional regulation for like sort of the semi-monopolies like Google, Facebook, etc. for a long time, but still not really happening. So this clear distinction, I believe, will create tension between these different parts of the world. And there's also countries that tend to, I would say, flip-flop or change their minds, like Singapore recently decided to live with COVID, whereas before they were quite strict. A common theme, which is arguably driven by COVID as sort of a catalyst, is that there's definitely a lot more government going on around the world, sort of less free markets. Yeah, all because of COVID. In the US, it's obviously that house evictions, etc., are stopped because of COVID, and government plays a big role. But also in general, of course, now the focus on new so-called green ESG kind of regulations. It's a bigger government. But I do believe that this split, let's say, and that's along the same lines, like China versus Europe, US, Japan, in terms of COVID measures, in terms of central banks, will inevitably lead to adjustments one way or the other from both sides. And this will lead to, when it happens, can lead to extreme lumps of volatility, especially, let's say, compared to the current levels where we are. So I think that will create interesting times going ahead. Obviously, also as it is not new, given that there, from the previous years, there's still this ongoing tension between China and US, primarily in the first place. So one final example of this, obviously, I think it's obvious to everyone, but obviously the Chinese internet social media companies versus the similar kind of companies in the US on the NASDAQ, like the Facebooks, etc. They have had an extreme bifurcation this year, with the one keep going up and the other ones, of course, having a decent correction. So this is primarily one of the sources is this bifurcation in policy as well. I think I'll leave it like this. Probably others have a few comments as well.
Okay, thank you, Govert. So, Jeff, can you add some of your comments to the market outlook?
Okay, yeah, I agree with Govert. Yeah, now for the markets, I think some big issues are COVID-19, the recovery, and also the inflation. The inflation issues caused by the central government uncontrollably pumped water to the markets. Now we are facing a very serious trouble ahead. So when the central banks will start to tap the liquidity, that will definitely have a whole lot of impact to the market. And another thing, as Govert just mentioned, is the internet correction, internet company correction, especially for the Chinese companies. So many people have some worry about the new policy, and actually, if you are in this market and also pay a lot of attention to the details of the new policy, you should not be worried about that. Okay, I stop it here.
Okay, so Will you have do you have anything to add?
Thanks, Jane. I agreed with what Govert and Jeff just said about the coronavirus and the outlook of the global macroeconomics. And from my observation, like Chinese economics has gone through a great resilience, mainly driven by the consumptions and export, which are beyond the expectations. But if we look at the outlook of the Chinese economy, it's still uncertain. We may know that the one of the indexes, the Chinese PMI of July, just dropped to below 50. So we already saw a great fluctuations in commodity markets, right? Including metals, energies, chemicals, and also they are increased turnover in the commodity markets. So another factor is when or to what extent will the Fed will increase the interest rate and start to quit QE. That would have a significant impact on the economics and also the financial markets in China, in US, and the rest of the world. So I tend to agree with the conclusion of the uncertainty given all these variables, and I also believe that derivatives market offer the critical functionality of the risk management for all the market participants. Yeah, thanks.
Okay, thank you for the panelists to share their view. And as an institutional investor in this market, I totally agree with everyone's comments. The uncertainty, the headwinds we experience, and for institutional investors like insurance company, we are feeling the pain because, as everyone mentioned, interest rate and the fixed income market is experiencing some, I would say, some pressure. But for institutional investors, we have pretty stable liability funding costs. So for us, lower the investment yield is not an option everyone will like. So that's why I want to raise my second question. Under such environment, what can we do? Should we just increase our risk, or what can we do to provide some downside risk protection, or even more, risk is also opportunity. And those uncertainty everyone mentioned, are there any asset class can feed into our investment portfolio, and how can we take advantage of those opportunities? For this question, I would like to ask Govert, as a specialist in volatility trading, to share his view.
Yeah, thanks, Jin. Yeah, so as I mentioned at the beginning, our firm is focused on volatility trading. So volatility as an asset class is actually an asset class that is still, I believe, overlooked by many. So volatility trading typically involves having convex exposure to trading, let's say, listed options, calls and puts, but also fixed futures and other volatility futures and similar kind of OTC contracts. So typically, a volatility or a long volatility exposure makes money when actual movements in the markets goes up, becomes more excessive, or the fear of market movement in the future goes up. And I think volatility as an asset class, when you compare it to all the other things, is kind of a true diversifier. Also, like last year when we had the very sudden down moves in March 2020, it was one of the few asset classes that had very high positive returns. So when you talk about volatility, then everybody, of course, immediately thinks of the VIX. But yeah, the VIX itself is an index, but not tradable. What you can trade are so-called fixed futures. And to give an example, as like a passive way of owning fixed futures is a so-called VXX ETF, which holds front months fixed futures and rolls them. That also is nice, and it gave if you look at March 2020, it gave an extreme return of about 100%, more than 100%. But for the whole year of 2020, actually, the return was just 10% or so. And this is partly because holding fixed futures has an enormous negative carry. Negative carry is similar to, let's say, commodity products that are in contango, although in the fix it tends to be a bit more extreme. Just as an example, the VXX ETF is down 60% or so year to date. So these numbers are quite extreme, but yeah, you have to imagine that this would mean that you would hold your whole portfolio, so for a full 100% in volatility, which is, yeah, I would say from a portfolio perspective, volatility perspective, almost the same thing as holding your whole portfolio in cryptocurrencies. So of course, yeah, because of this negative carry, the typical way to go about it for volatility trading is to trade much more actively than just simply holding it. So for this, actually, a good place to look is what is called the CBOE Eureka Hedge Volatility Indices. So differently from the VIX, this is an index of volatility asset managers. Yeah, that trade volatility. There's a long volatility index, a relative value volatility index, and a few others. So if you look at such an index, that index was up 25% in 2020 and primarily made all the returns in February, March of that year. And only, let's say this year in 2021 is only down about 7%. So when you have a more active trading approach, and of course, a little bit less extreme volatility exposure, you can see that it can act very well as a diversifier, especially compared to, let's say, equity markets, having a long equity portfolio. And there's also, when we talk about downside risk protection, I think nowadays, if you simply look at yeah, I wouldn't say old-fashioned, but simply look at, let's say, the 60-40 stocks bond portfolio. You currently have a situation, of course, that European 10-year yields, at least the German ones, are still severely negative at minus 30 basis points or so. In Japan, it's 0. The US is only 1%. So the question is still whether, yeah, when you have, let's say, a market correction, normally the bonds would give some protection on your portfolio side. At least it did in the past, like 2000, 2008, and to a limited effect in March 2020. But the question is, of course, if the next correction occurs, how far central banks can still push the interest rates down and therefore have a positive return on your bond portfolio to help offset your equity portfolio. So this is actually the case, and with the current inflation environment, yeah, it's looking back a little bit further, obviously. But if you get a situation slightly more like the 70s, where bonds, sovereign bonds, are actually more or less a little bit more of the problem in itself, with the rates going up steeply, then of course your bond part of your portfolio will not give you any protection at all. So of course this is not, let's say, an argument to go fully into, let's say, long volatility and volatility products. However, even let's say 5, 10, or 15%, let's say, part of your portfolio in these volatility products can obviously be quite beneficial in terms of, let's say, reducing risk, reducing drawdown, and increasing Sharpe ratio.
Thanks a lot, Govert, for the introduction of the benefit to introduce volatility as an asset class to our portfolio. You also mentioned a little bit about the commodity. So I know Jeff is an expert on commodity. Could you, Jeff, share something about the benefit from introducing commodity to our investment portfolio?
Oh, thank you. Actually, commodity actually is related to another topic I just forgot to mention about related to the inflation. It's the Biden infrastructure bill. That will, after the bill passed, that will actually push up the inflation quite a lot. So that is something people need to be worried about. Obviously, commodity is another dimension of the assets. But let me take one step back to answer your question. What will be the solution, the best solution going forward? As a fund of hedge fund manager or participant in the market, I would say fund of hedge funds is the best solution for the institutional investors, especially for the insurance companies. Because for fund of hedge funds, you make investments in 5 categories, in 5 asset classes, in the equity, in the fixed income, in the commodity, in the FX, and also in credit. You can go long and you can short, right? You can select a group of manager long in each of this category and short in each of this category, and so on. And for example, Govert just mentioned about the fixed income, the interest rate. We know that the interest rate is very, very low, and some of the countries is negative. So it's quite unlikely for the interest rates to go even lower. So when interest rates go up, then the bond investors will suffer. So for this kind of 60-40 or 70-30 combination of the equity bond portfolio, they are going to suffer on the bond side for sure. However, if you go fund of hedge funds, then you can select some managers to be able to do arbitrage or hedging in the fixed income space. They can be benefit from all this kind of interest rate movement, not only the jump of the interest rate, but also the change of the shape of the yield curve. You can have a lot of ways to play this game. And similar thing for the commodity. For the Biden infrastructure bill, that will have a huge demand for the commodity. However, no tree will grow up to the moon. So fluctuation is something always stay in the market. As Govert just mentioned about trading the volatility is one of the way. However, I would say that trading volatility is some kind of short-term gain. volatility will not sustain for long term. So if it's a spike, it's better to take action, right? But for the fund of hedge funds, it's a much longer term investments. So that will provide investors a stable and more healthy return risk adjusted investments. So Jim,
Okay,
I
thank
stop
you.
here.
Yeah, thank you, Jeff. And I totally agree with your comments about the fund of fund approach, especially for institutional investor. My way of taking it is that for an institutional investor, especially when our investment horizon is like 20, 30 years, it's unlikely for us to have in-house expertise that can take advantage of any market condition. So by doing fund-on-fund approach, we can explore the emerging marketing opportunity with relatively low cost of investment admin. So I do like that kind of idea. So, and also, I think both of Govert and Jeff, the strategies you mentioned a little bit, I think the derivative will play a key part in the strategy you mentioned. So everyone probably are interested in knowing what is the Chinese derivative market. And for all the good idea you just brought up, can then be durable in China? So to answer this question, I want to ask Will, as the local expert, to share some light.
Thanks, Jane. As I introduced before, Optiver has operated in China in local market for more than 8 years. So actually, we witnessed the rapid growth and the development of China financials derivatives market and also the commodity derivative market. So I'd like to share some observations. Firstly, as of today, as you may know, there are already near 100 listed futures and options contract in China. And the product actually coverage kept expanding to better serve the so-called real economy and major industries, including non-ferrous metals such as copper, ferrous metals such as iron ore and rebar, and agriculture such as soybean meal, energy product such as crude oil. Actually, they serve all kinds of major industries. And at the same time, the market capacity has significantly improved in recent years. It is quite worthy mentioning that according to FIA, the volume of Chinese commodity futures and options in first half and this year, 2021, accounted for near 70% of the global market. So we could imagine the market potentials if the Chinese regulators feel more comfortable to develop the financial sector as well. So that's the first point. Secondly, we saw growing participation of the industrial clients and asset management in futures and options market. There are several interesting numbers that I would like to share. By end of this July, the futures margin from the financial institutions, such as mutual fund, private fund, PFM, security, asset management, insurance, and etc., accounted for 35% of the entire market. So that's huge. The number of listed companies in China, which utilized the derivatives for hedging, accounted for 15% of the all listed company. So the number are even more promising for specific industries. All China's top 15 non-ferrous producers has engaged in the futures market, as well as 90% of the large or medium soybean producers. So we really believe that serving the demand of the end users is the only reason why this market existed, and also one of the key principles for the healthy market. So the second point. And lastly, I would like to share my a little bit of my thought on the offshore participation in China's futures market. I believe in previous panel there must be deep discussion on the access channels such as the internationalized product region or KIFI. So I don't need to comment more on that. I want to share some certain numbers to prove the vitality of the market. Now, the offshore investors can access 9 products, including 2 options, which is crude oil options in INE and palm oil options in DCE. Actually, I don't underestimate the ambition of Chinese futures exchange about the plan of internationalization. In terms of the liquidity of those products, SHV crude oil, INE crude oil futures has been the 3rd liquid crude oil product since 2018, and its crude oil options is the representative and the benchmark of the volatility, especially in Asia hour. So we were talk a lot about the volatility. I think that's the benchmark. For DCE palm oil futures, it actually the most liquid palm oil contract, and it's the 2nd liquid agriculture contract globally. So for globally investors, they could explore more on those products, such as the market and demand is so significant to ignore. So it's just too big to ignore. It's quite encouraging that offshore clients shows their presence in those products. According to stats disclosed by the exchange, for SHV, for INE crude oil options, offshore clients contribute 20% of the daily average turnover and 25% of the daily average open interest. So I also observed that many global leading commodity trading house have opened local office or set up the subsidiaries in local China. So they all have deeply involved in the commodity market and use those markets to manage their risks. So besides the exchange traded product, we have also witnessed the development of the OTC derivatives, which actually supported by the exchange traded futures options. So this is actually obviously a fast-growing market, and I envision more development and opportunity to come. Yeah, thanks.
Okay, thank you, Will, for those very promising introduction of local Chinese derivative market. And since we all are here, so I'm just trying to ask 3 panelists, do you have any suggestion to our audience or to our regulator how to take advantage and not take advantage, how to do the investment in the current environment? So any panelists trying to share the view first? Then just please unmute. How about Jeff?
Yeah. Okay, all right. Yeah, for the regulators, I think, as I mentioned about the internet companies crash happened recently, actually, the market was caught by surprise when the policies, a series of policies came out to the market. However, when you read into the policies deeper and deeper, more and more in details, then you feel that, wow, it's actually some good things, all right? So for the regulators, I think a lesson for this is to increase the communication with the market participants efficiently and effectively to explain the meaning, motivation for all this, and also what's the mission you're trying to get, right? So now the market start to come down, and now we see the market start to bounce back, and also for the U.S. and also international regulators or the central banks and so on. Although they have been trying to communicate with the market participants, especially the U.S. Fed. However, are they talking about their true belief? I actually doubt. And the U.S. Fed chairman keeps saying that the inflation is only temporary. However, if you look at the details all behind this, right? COVID-19 and also the bonds limits, and also this kind of infrastructure bill and so on. If you put all this together, you really cannot get to the conclusion that the inflation is temporary. So market participants are not priced in for a longer term inflation situation, right? And also for the COVID-19, I think definitely I'm not an expert on that. However, we have been suffering for this COVID-19 shutdown for almost 2 years. So what I'm very worried about is for this kind of vaccine, the vaccine at the very beginning made people feel comfortable. Now, a lot of people arguing that for people got vaccines, they are actually the risk carrier. And some airline advise people who got the shot, don't take the airplane. So at the end of the day, if people find that the vaccine is not help at all for this COVID-19, then the market will get very, very shocked. That will be a big risk. I'm very concerned about.
Yes, yeah, exactly. Better communication is the key for all the regulators, I would say. And thanks for all the panelists for today's very informative discussion. We talk about the market outlook. We talk about what's the investment strategy we can explore, and we'll share about the Chinese local derivative market. I hope everyone enjoyed today's panel discussion, and I will handle the panel discussion back to Joy.
Hi. Hello. Yeah, thank you, Jane, for moderating the panel, and that was really informative. I also like to thank Jeff, Govert, and Will for sharing your views on trading and investment opportunities and strategies, as well as tools to manage risk in this volatile market. Thank you also to the delegates for sending in your questions and interacting with the panel. So we hope you have enjoyed this session. Next, in a few minutes at 4:45, we'll have a fireside chat on equity, futures, and commodities presented by B3, the Brazilian Stock Exchange, joined by Juca Andrade, the Chief Product and Client Officer of B3, and Richard De Bruin, the Managing Partner of Compass Partners. Thereafter, we will reconvene at 5:10 with the panel discussion on commodities and inflation hedge amid decarbonization. So stay online and see you in a while. Thank you again for the panelists. Thank you. Bye-bye.